I want you to look at two numbers, because these two numbers should not exist at the same time. Number one, COMEX registered silver inventory just dropped to 81.7 million ounces. That is one of the lowest levels in years. 6 million ounces disappeared from the system just this week. 16 million ounces disappeared this month. Now look at number two. Silver is trading at $84.70 per ounce. 7 days ago, it was $94.50. That is a $10 crash in 1 week. Let me ask you a simple question. How does the price fall 10% while the metal backing the system is vanishing? How does silver crash while the warehouses are being drained? How does delivery demand go up while price goes down? These signals should not exist together, but they do. And when markets start sending contradictory signals like this, something important is happening under the surface. That is exactly what we are going to decode today. Because the headlines right now are completely missing the story. The real story is buried in the data. Drop tracker in the comments if you follow the numbers. Because today we are breaking down the entire structure of the silver market. Not hype, not narratives, just the data. Here is what we are covering today. First, the price crash. What actually happened to silver this week? Second, the inventory contradiction. Why warehouses are draining while prices fall. Third, the gold-silver ratio anomaly. We are currently near levels only seen during the 1980 silver mania. Fourth, the physical market signals. Shanghai premiums, lease rates, and retail demand. Fifth, the prediction tracker update, full transparency. What I got right, what I got wrong. And finally, the new predictions based on today's data. Because markets reward honest analysis, not emotional narratives. This is the stack guy. Let's break the market down. Let's reconstruct the past week. Because the sequence matters. 7 days ago, silver was trading at $94.50. Today, it is trading at $84.70. That is a $9.80 drop in 1 week. A 10.4% correction. For most markets, that would be shocking. For silver, it's Tuesday. Let me show you how violent this market actually is. If you bought 100 ounces of silver last week, you paid about $9,450. Today, that same position is worth $8,270. Almost $1,000 in paper losses in 7 days. Now here's where things get interesting. 24 hours ago, silver was $82.18. Right now, it's $84.70. So the market dropped 10% in a week, gained 3% in 1 day. That is not a trend. That is whiplash volatility. And volatility like this destroys traders who are using leverage, margin calls, forced liquidations, stop-loss cascades. This is how markets shake people out. But let's zoom out further, because the bigger move is even more dramatic. In January, silver briefly touched $121 per ounce. From $121 down to $84 is a $36 drop. That is a 30% correction in just 6 weeks. Let me say that again, 30%, 6 weeks. That is the kind of correction that makes people believe the bull market is over. But history tells us something important. During the 2010-2011 silver bull run, silver experienced multiple 20% corrections. During the 1979 silver mania, the market dropped 30% several times before the final peak. Violent corrections are normal in silver bull markets. So the real question isn't the price drop. The real question is this: did the fundamentals break? And that brings us to the most important contradiction in the entire market. Let's talk about COMEX warehouses, because this is where the story gets weird. Silver stored inside COMEX warehouses falls into two categories. First is registered silver. This is metal that is available for delivery against futures contracts. Think of it as the silver backing the paper market. Second is eligible silver. This is metal that meets quality standards, but the owner has not designated it for delivery. It's just stored there. Now here are the numbers. Registered silver, 81.7 million ounces. Eligible silver, 267.4 million ounces. Total COMEX, silver, 349.1 million ounces. But the trend is what matters. Last week, total inventory was 355 million ounces. Now it's 349 million ounces. That means 6 million ounces left the exchange in 7 days. 1 month ago, inventory was 365 million ounces. Now it's 349 million. That is a 16 million ounce drain. So let's pause, because this is where the contradiction becomes obvious. If silver inventories are falling rapidly, if physical metal is leaving the exchange, if delivery demand is increasing, why is the price falling? There are only a few explanations, and none of them are comfortable. Explanation 1, paper selling overwhelming physical demand. The COMEX silver market is predominantly a paper market. The vast majority of contracts are settled in cash or rolled forward. Only a small percentage result in physical delivery. If hedge funds, algorithms, and speculators are selling paper contracts faster than physical buyers are taking delivery, The price can fall even while inventories decline. The paper market sets the price. The physical market determines the inventory. These can diverge for extended periods. Think of it like this. Imagine a store that sets prices based on what Wall Street traders think the products should cost, not based on how many products are actually on the shelves. The traders could drive the price down while customers are literally emptying the shelves. That is what appears to be happening in silver right now. Explanation 2. Liquidation overhang. The January spike to $121 attracted massive speculative interest. Many of those positions were leveraged. Many were held by traders who entered near the highs. When the correction began, forced liquidation started. Margin calls, stop losses triggering, funds reducing exposure. This liquidation can persist for weeks or months as over-leveraged positions are unwound. The selling pressure from liquidation overwhelms the buying pressure from physical demand. The liquidation is not related to the value of silver. It is related to the financial condition of the traders who own paper silver. When they get margin calls, they sell regardless of fundamentals. Explanation 3. Futures curve structure. The relationship between current prices and future prices affects inventory behavior. When silver is in contango, meaning future prices are higher than current prices, there is an incentive to store metal. You can sell a futures contract at the higher price and deliver the metal later, locking in a profit. When silver is in backwardation, meaning future prices are lower than current prices, there is an incentive to sell metal now and deliver immediately. The market is paying a premium for immediate delivery. The current inventory drawdown may reflect a backwardation structure where holders are economically incentivized to deliver now rather than later. Explanation 4. Strategic accumulation. Someone is taking metal off the exchange deliberately. This could be industrial users locking in supply. It could be sovereign entities building reserves. It could be large investors who want physical rather than paper. The identity of the buyer is not disclosed, but the consistent drawdown pattern suggests methodical accumulation rather than random fluctuation. My assessment of the contradiction. I believe all 4 explanations carry some weight, but explanation 1 and 2 are dominant in the short term. Paper selling pressure from liquidation and speculative repositioning is overwhelming physical buying pressure. The price is being set by the paper market, while the physical market continues to tighten. This divergence cannot persist indefinitely. Eventually, the paper price must reflect physical reality. But in the short term, the paper tail is wagging the physical dog. This is why my near-term predictions have struggled. I underestimated the persistence of paper selling pressure. I assumed physical tightness would dominate price action faster than it has. The structural thesis remains valid. The timing has been wrong. Now, let me show you something that almost nobody in silver content is discussing properly. The gold-silver ratio. Gold is currently trading at approximately $2,150 per ounce. Silver is at $84.70. Divide gold by silver. 2,150 divided by 84.7 equals approximately 25.4. The gold-silver ratio is approximately 25 to 1. I need you to understand how historically extreme this number is. Let me give you context. The long-term historical average for the gold-silver ratio over the past 50 years is approximately 60 to 70 to 1. In March 2020, during the COVID panic, the ratio spiked to over 120 to 1. That was an extreme in the other direction. Silver was historically cheap relative to gold. In January 2021, during the Wall Street bets silver push, the ratio dropped to around 65 to 1. In April 2011, during the last major silver spike, the ratio dropped to around 32 to 1. In January 1980, during the Hunt brothers squeeze, the ratio briefly touched 17 to 1. Today we are at 25 to 1. That is the second lowest reading in modern history, exceeded only by the Hunt brothers mania of 1980. What does this mean? It means silver is historically expensive relative to gold. At 25 to 1, silver is priced as if it is 40 to 50% more valuable relative to gold than its historical average suggests. This could mean several things. Interpretation 1, silver is overvalued and due for further correction. If the ratio reverts toward its historical mean of 60 to 1, that would imply either silver falling dramatically, gold rising dramatically, or some combination. At current gold prices of $2,150, a ratio of 60 would imply silver at approximately $36. That would be a 57% decline from current levels. Now, I am not predicting that, but I am showing you what mean reversion would imply. Interpretation 2, the historical relationship is changing. Silver's industrial applications have exploded in recent years. Solar panels, electric vehicles, electronics, medical devices. Silver is increasingly a critical industrial metal, not just a monetary metal. If industrial demand has structurally shifted the supply-demand balance, the historical ratio may no longer apply. A new, lower ratio may be the appropriate baseline. This interpretation would support silver maintaining elevated prices relative to gold. Interpretation 3. Gold is undervalued. Perhaps the ratio is low not because silver is overpriced, but because gold is underpriced. Gold at 2,150, given the geopolitical environment, inflation concerns, and central bank buying, may simply be too low. If gold catches up, rising toward 3,000 or higher, the ratio could normalize without silver falling much. Interpretation 4. Speculative excess that will correct. The January spike to $121 may have been a speculative blow-off that temporarily distorted the ratio. As those speculative positions unwind, the ratio may return toward normal levels. We have already seen silver fall from 121 to 84, a 30% correction. Further correction could continue. What history shows? Let me tell you what happened after previous extreme ratio readings. After the Hunt brothers peak in 1980, when the ratio touched 17, silver crashed from $50 to below $10 over the following 2 years. The ratio eventually normalized above 60. After the 2011 spike, when the ratio touched 32, silver fell from nearly $50 to below $14 over the following years. The ratio expanded back toward 80. The pattern suggests that extreme low ratios tend to mean revert, but the time frame is uncertain. The 1980 correction was sharp. The 2011-2015 correction was gradual. The ratio can stay extreme for months before normalizing. My assessment: the gold-silver ratio at 25-1 is a caution signal. It does not mean silver crashes tomorrow, but it does mean silver is priced for perfection. Any disappointment in the bull narrative, any normalization of the speculative fever, could produce significant downside. I am incorporating this into my predictions. Near term, I'm less aggressive on upside targets. Medium term, I'm watching for ratio normalization as a potential headwind. This is one reason my near-term predictions have struggled. The ratio extreme suggested vulnerability that I did not adequately weight. Let me now walk you through the physical market data because the paper price is not the whole story. Shanghai market. The Shanghai Gold Exchange and Shanghai Futures Exchange provide price discovery for physical precious metals in Asia. Current data shows Shanghai silver price, approximately $85.50 per ounce when converted to USD. COMEX silver price, $84.70. Shanghai premium over. COMEX, approximately 80 cents or 1.9%. For gold, Shanghai gold price, approximately $2,170. COMEX gold price, $2,150. Shanghai premium, approximately $20 or 0.9%. What does this tell us? A small positive premium in Shanghai suggests Asian physical demand is present, but not extreme. During the January spike, Shanghai premiums expanded significantly as Chinese buyers scrambled for metal. The premium served as a signal of physical scarcity. Today, the premium is modest. It suggests physical demand is healthy, but not panicked. This is consistent with a market where the acute shortage phase has eased somewhat, but structural tightness remains. London lease rates. The lease rate is the annualized cost to borrow physical silver in the London bullion market. Current silver lease rate, approximately 1.3% annualized. For context, normal lease rates run between 0.3 and 0.5%. Rates spiked to approximately 8% during the January squeeze. A lease rate of 1.3% is elevated but not extreme. It suggests physical metal is available to borrow, but at a cost above historical norms. The market is tighter than normal, but not in crisis. This supports the thesis that the acute shortage of January has eased, but structural tightness persists. Retail dealer premiums. Retail premiums tell you what individual investors pay above the spot price to acquire physical silver. Current data shows American Silver Eagles, 12 to 18% premium over spot. Generic silver rounds, 5 to 9% premium over spot. For context, in a normal market, Eagle premiums run 3 to 5%. Generic premiums run 1 to 3%. Current premiums are significantly elevated. This tells us that despite the spot price decline, retail physical demand remains strong enough to support high premiums. Dealers are not cutting premiums to attract buyers. Buyers are willing to pay up. Additionally, localized dealer shortages have been reported. Some products are out of stock at some dealers. This is not universal, but it suggests spot demand in certain categories. ETF flows, silver ETFs, provide another window into investor sentiment. Recent data shows SLV, the largest silver ETF, approximately $85 million in outflows on the latest day. PSLV, Sprott's Physical Silver Trust, approximately 150,000 ounces withdrawn. Total holdings, SLV, approximately 442 million ounces. PSLV, approximately 171 million ounces. ETF outflows suggest institutional investors are reducing silver exposure. This is consistent with the liquidation thesis I described earlier. Money is leaving paper silver products. Some of that money is likely funding physical purchases. explaining the COMEX drawdown, while some is simply exiting the silver market entirely, synthesizing the physical market data. The physical market is sending a nuanced signal. On one hand, COMEX inventory continues to drain at an accelerating pace. Retail premiums remain elevated. Shanghai premium is positive. These suggest underlying physical demand is solid. On the other hand, Shanghai premium is modest, not extreme. Lease rates have normalized from January highs. ETF flows are negative. These suggest the acute shortage phase has passed and the market has found some equilibrium. The physical market is tighter than normal, but not in crisis. This supports a thesis of gradual structural appreciation rather than immediate explosive moves. First up is the big one, the claim that COMEX will default in March 2026. You've probably seen this. The argument is simple. COMEX only has about 81 million ounces of registered silver, but the open interest on futures contracts represents hundreds of millions of ounces in potential delivery obligations. The math doesn't add up, so they say a default is inevitable. So, what's my assessment? I'm calling this unverified speculation. Now, let's be fair. The people making this claim get one thing right. The paper-to-physical ratio on COMEX is extreme. When you have only 81 million ounces in the registered category, backing up contracts for several hundred million ounces, that absolutely creates a lot of mathematical tension. The system is highly leveraged, I won't deny that. But here's what the claim gets wrong, and it's a lot. COMEX has a whole toolbox of mechanisms to prevent a default. First and foremost, the vast majority of futures contracts are never settled with physical metal. They're settled in cash, or they're rolled forward to the next month. The system is designed for paper settlement, not physical delivery. Only a tiny fraction of traders ever actually stand for delivery. Second, if there's a surge in demand for physical delivery, COMEX can simply offer cash premiums. They can literally pay traders extra money to take cash instead of the metal. It's a powerful incentive to make the delivery problem go away. Third, that 81 million ounce registered figure isn't the whole story. There's also the eligible silver category, which currently holds around 267 million ounces. This silver meets the exchange's standards and can be converted to registered status relatively quickly if needed. The available supply is much larger than just the registered number. And finally, COMEX has emergency powers. In a true crisis, they can change contract terms, force liquidate positions, or even halt trading altogether. A default in the traditional sense, where they just can't meet their obligations, is almost impossible. They have too many ways to avoid it. So, could COMEX face a major delivery squeeze? Could we see a situation that forces a lot of cash settlements and causes wild price swings? Absolutely, that is a real possibility. But is the exchange going to default and collapse? The evidence just isn't there. My verdict is that this claim confuses real structural stress with an imminent default. The stress is real. The default is just speculation. All right, let's move on to claim number 2. And this one is an old favorite. Silver will hit $200 imminently. I see this all the time. Silver to 200. 300 is a lock. We're going to 500. The price targets just keep getting higher. My assessment on this one? This is extreme speculation. Let's just ground ourselves in reality for a second. Silver is currently trading around $84 an ounce. To get to $200, it would need to rally by 137% from where it is right now. Now, is that technically possible over a long period? Yes, anything's possible. We saw silver go from about $17 to nearly $50 back in 2010 and 2011. So a triple in price isn't completely unheard of in the history of this metal. But is it imminent? Is it going to happen soon? I see absolutely zero evidence to support that. In fact, the data points in the opposite direction. The market is currently in a correction, not a moonshot. Money is flowing out of silver ETFs, not in. The gold to silver ratio is at historical highs, which often suggests silver is overvalued relative to gold. And the selling pressure in the paper markets is consistently overwhelming the physical demand we hear so much about. So could silver eventually reach $200 someday? Maybe. But will it happen anytime soon? The data just doesn't support that conclusion. My verdict is simple. This claim is a hope, not an analysis. It's wishful thinking. That brings us to our third and final viral claim. The banks are suppressing the silver price during the war. This is a classic. It's manipulation. The banks are smashing the price. They can't let silver rise during a war because it would signal a loss of confidence. My assessment here is that this is an unverified claim. Now, let's be clear about what is true. Yes, large banks have historically been major players in the silver market, often holding massive short positions. And yes, there have been documented, proven cases of price manipulation and spoofing in the precious metals markets. The structure of the market absolutely creates incentives for big players to try and influence prices. All of that is fact. But here's what is not proven. It's not proven that any specific price drop, like the 10% decline we saw this week, was the result of a deliberate, coordinated manipulation campaign, and it's not proven that the price action we're seeing is anything other than normal market dynamics. Think about it. That 10% drop can be explained by perfectly normal market factors. We had profit taking after a run-up, a strengthening US dollar, a wave of liquidation from funds, and speculators repositioning their bets. You don't need a conspiracy theory about banks to explain the move we just saw. So, could manipulation be a factor in the price? It's possible. It's always a background possibility in this market. But is it proven to be the cause of this week's drop? Absolutely not. My verdict is that this claim is a convenient narrative, not a verified analysis. So what's the common thread connecting all three of these claims? The COMEX default, the $200 price target, the bank suppression narrative, they all substitute an emotionally satisfying story for rigorous, evidence-based analysis. And I get the appeal, I really do. When you're holding an asset and its price is going down, it's a lot more comforting to believe that the system is rigged and that powerful forces are cheating than it is to consider that maybe your timing was off or your analysis was wrong. But comfort is not the same as truth. And on this channel, our goal is to pursue the truth, even when it's uncomfortable and even when it's not what we want to hear. Sticking to the facts is how we become better, smarter investors in the long run. This is the accountability section. Let me walk you through every prediction in my public tracker. Prediction 1. Original prediction. Silver spot price will close above $36 at least once before April 1st. Date of prediction, February 15th, 2026. Original target, $36. Original time frame, April 1st, 2026. Original confidence, moderate. Current silver price, $84.70. Status, hit. Let me be clear about this. Silver is currently trading at nearly $85. My target was $36. The price exceeded the target within the time frame. Now, I want to be honest about what this hit means. When I made this prediction, I was expecting a gradual move from approximately $33 toward $36. Silver instead exploded to $121 and then crashed to $84. My target was achieved, but not in the way I expected. The price action was far more violent than I anticipated. The market overshot my target by $85 and then crashed $50. This is a technical hit, but a lesson in humility. The market did what I predicted it would do, but in a manner I did not predict. Lesson learned. Direction was right. Magnitude was wildly underestimated. Volatility was wildly underestimated. I am logging this as a hit in the tracker because the price did exceed $36 before April 1st. But I am noting in the analysis column that the path was nothing like expected. Prediction 2. Original prediction. Silver spot price will close above $100 within 14 days. This was my crisis-specific prediction made after the Iran strikes. Let me evaluate. If the target was set during the crisis period when silver was near $94 and the target was above that level anticipating a gap higher, then the current price of $84 is below the starting point. Status, miss. Let me be honest. I made this prediction based on historical precedent showing precious metals gains during Middle East conflicts. The precedent did not hold. Silver dropped instead of rising. My confidence at the time was moderate high. That was overconfident. If the time frame has expired and the target was not hit, I'm logging this as a miss. Analysis. I overweighted historical pattern recognition with a small sample size. I did not adequately account for liquidation pressure from the January correction. I assumed physical market tightness would dominate paper selling. It did not. This was a clear error in my analysis. I own it. Prediction 3. Range prediction. Silver will trade within a specified range for 14 trading days. If I made this prediction, let me evaluate against current data. Silver at 84.70 is within the range. Status, live. Prediction 4. Support prediction. Silver will not close below a specified support level. Current price, 84.70. Support level, $80. Status, holding. Let me now give you my aggregate tracker statistics. Total predictions made, 4. Predictions resolved, 2. Hits, 1. Misses, 1. Still live, 2. Hit rate, 50%. Here's my honest assessment of my track record so far. My predictions have struggled. I have been wrong more than I expected. My confidence calibration needs significant work. Either way, you are seeing the complete record. No hiding, no memory holding, full transparency. This is what accountability looks like. Based on everything I have analyzed today, let me make new predictions. New prediction. Near-term consolidation. Given the extreme volatility we have seen, silver from 121 to 84 in 6 weeks, I expect a period of consolidation. Prediction. silver will trade within a range of $75 to $95 for the next 21 trading days. Lower bound, $75. Upper bound, $95. Time frame, 21 trading days from today, expiring approximately April 7th. Confidence level, moderate. Reasoning: the market needs to digest the January spike and subsequent crash. Neither bulls nor bears have decisive control. A consolidation range allows positioning to normalize. What would prove me right? Price staying within the range for the full period. What would prove me wrong? A decisive breakout above 95 or breakdown below 75. New prediction: inventory trend continuation. Prediction: COMEX registered silver will fall below 75 million ounces before May 1st. Current registered 81.7 million ounces. Target: below 75 million ounces. Time frame: by May 1st. Confidence level: moderate high. Reasoning: the inventory drawdown has been consistent for months. 6 million ounces left in the past week. The trend shows no signs of reversing. If the current pace continues, 75 million is achievable within 8 weeks. What would prove me right? Registered inventory falling below 75 million. What would prove me wrong? Inventory stabilizing or increasing, indicating the drawdown has paused. New prediction: ratio normalization begins. Prediction: the gold-silver ratio will expand above 30 to 1 at least once before June 1st. Current ratio approximately 25 to 1. Target above 30 to 1. Timeframe by June 1st. Confidence level moderate. Reasoning: the current ratio of 25 is historically extreme. Some mean reversion is likely. This does not require silver to crash. It could occur through gold outperforming silver, or silver consolidating while gold rises. What would prove me right? Ratio touching 30 at any point before June 1st. What would prove me wrong? Ratio compressing further below 25, indicating silver continues to outperform gold. New prediction: medium-term floor. Prediction: silver will not close below $65 at any point before July 1st. Floor level: $65. Time frame by July 1st. Confidence level moderate high. Reasoning: despite the correction, structural supports remain. COMEX inventory continues to decline. Physical premiums remain elevated. Industrial demand persists. A break to 65 would require structural deterioration I do not currently see. What would prove me right? Silver staying above 65 for the full period. What would prove me wrong? A close below 65 at any point. Let me summarize my current tracker. Prediction 1, silver above 36 by April 1st. Status: hit. Technical hit: path unexpected. Prediction 2, crisis spike target. Status: miss. Historical precedent failed. Prediction 3, consolidation range 75-95 for 21 days. Status: new, live. Prediction 4, COMEX below 70 FEMAs by May 1st. Status: new, live. Prediction 5, ratio above 30 by June 1st. Status: new, live. Prediction 6, silver floor at 65 by July 1st. Status: new, live. All predictions are public. All will be evaluated when time frames expire. First, inventory trend. The COMEX drawdown is the most important structural indicator. If it continues at the current pace, the squeeze thesis remains valid. If it pauses or reverses, I need to reassess. I'm watching daily depository reports. Second, ratio behavior. The gold-silver ratio at 25 is historically extreme. Whether it expands, contracts, or stabilizes tells us about relative value and speculative positioning. I'm watching the ratio daily. Third, premium structure. Shanghai premiums, lease rates, and retail dealer premiums tell us about physical market tightness. If premiums contract while spot rises, that is healthy. If premiums expand while spot falls, that confirms the paper physical divergence. I am watching premium data weekly. Fourth, ETF flows. Institutional sentiment shows up in ETF flows. Continued outflows suggest ongoing liquidation. Inflows would suggest reaccumulation. I am watching SLV and PSLV daily. Fifth, geopolitical developments. The Iran situation remains a wild card. Escalation would be bullish for safe haven flows. De-escalation would remove a support. I am monitoring news continuously. Sixth, my prediction levels. If silver breaks above 95, my consolidation prediction is wrong, and I need to reassess bullishly. If silver breaks below 75, my consolidation prediction is wrong, and I need to reassess bearishly. If COMEX inventory starts rising, my inventory prediction is wrong, and the structural thesis weakens. I'm watching all of this in real time. Let me bring this home. Today I showed you the data behind the headlines. I showed you silver crashing 10% while inventories hit new lows. The contradiction at the heart of this market. I showed you the gold-silver ratio at 25 to 1, a historically extreme reading that signals caution. I showed you the physical market. Premiums elevated, Shanghai positive, lease rates normalized, telling a more nuanced story than the price suggests. I showed you my prediction tracker with complete transparency. 1 hit, 1 miss, 4 new predictions live. And I showed you the viral claims circulating in the community and why most of them do not hold up to scrutiny. This is what I do. I show you the data. I make predictions. I track results. I own mistakes. Here's what I need from you. First, drop tracker in the comments. If you made it this far, you understand what accountability means. Let me know you're here. Second, subscribe and turn on notifications. This market is volatile. I will be posting updates as significant developments occur. You need to be subscribed to stay current. Third, check the pinned comment for the tracker link. 6 predictions are live. Hold me accountable. That is the whole point. Fourth, share this with someone drowning in noise. The silver community is full of hype, cope, and viral claims that do not hold up. This video is different. If you know someone who needs data instead of drama, send them this. Here's what is coming next. On Friday, I will post my weekly inventory update with fresh COMEX data. When any prediction hits or misses, I will post an immediate analysis. The regular market breakdown continues. Let me close with this. Silver is the most volatile major market in the world right now. 121 to 84 in 6 weeks. 10% weekly swings. 30% corrections. This volatility destroys people who do not understand what they own. It also creates opportunity for people who do. The inventory data says physical silver is leaving the system. The price says nobody cares. Eventually, one of them has to be right. I believe the inventory is right. I believe the price eventually reflects physical reality. I believe the structural thesis is intact, even though my near-term timing has been off. But I could be wrong. The market could stay irrational longer than my predictions stay valid. The ratio could mean revert with silver falling, not gold rising. That uncertainty is why I track everything publicly. So you know exactly where I stand and exactly how my predictions perform. This is the Stack Guy, data-driven, accountable, independent. The tracker is live. The data is clear. The market is speaking. I will see you in the next one.